Index funds or ETFs? Which one's better? If you've ever Googled how to start investing, you've probably seen both thrown around as the smart choice for beginners. But here's the thing, while they look almost identical, there have some small differences that can make a great difference in the long term. So today we're breaking down what they are, their similarities and differences, and finally, which one might actually be the better fit for you. So let's break down index funds. Imagine you want to invest in the stock market, but you don't know which companies to pick. Should you buy Apple, maybe Tesla, or play it safe with Coca-Cola? The problem is, nobody really knows which single stock will do the best. That's where index funds come in. An index fund is like a giant basket that holds a bunch of different stocks, usually designed to track a specific index. For example, an S&P 500 index fund owns shares of all 500 of the biggest U.S. companies, from Apple and Microsoft to McDonald's and Walmart. So when you buy one share of that index fund, you instantly get a little piece of all those companies. You don't have to worry about guessing. If the overall market goes up, your investment goes up with it. And because index funds don't have expensive managers trying to beat the market, they're just copying it. The fees are super low compared to traditional mutual funds. Most index funds charge an annual fee, called an expense ratio, of anywhere from 0.02% to 0.20%. That means if you invest $1,000, you might pay just 20 cents to $2 per year in fees. This is because they are passively managed. One key thing to know, index funds are priced only once a day. At the end of each trading day, the fund calculates something called its NAV, net asset value, which is basically the average value of all the stocks inside it. No matter when you place your order, you'll get that end-of-day price. Another interesting benefit of index funds is how they're treated in some countries when it comes to taxes. For example, in certain places, you can switch from one index fund to another, say from an S&P 500 fund to an international stocks fund, without triggering a taxable event. That means you don't have to immediately pay capital gains taxes just because you reallocated your investments. Of course, this depends heavily on the tax rules where you live, but it's one of the reasons index funds are often used in retirement accounts and long-term portfolios. For example, in the US, selling one index fund to move your money into another is considered a taxable event, so you'd likely owe capital gains taxes, meaning this isn't really an extra benefit. However, in countries like Spain, some regulations allow you to switch between funds without triggering immediate taxes, letting your investments grow tax-deferred until you eventually cash out. Let me know what's your opinion on this. Index funds are offered by major fund providers like Vanguard, Fidelity, or BlackRock. Each management company has its own policies on how and when your order is executed, but in general, all index fund trades are processed once per day at the fund's closing price. Now that we've covered index funds, let's talk about ETFs, or exchange-traded funds. On the surface, they can look very similar. You can get exposure to hundreds of stocks or bonds in one single investment, just like an index fund. For example, an S&P 500 ETF holds shares of all 500 big U.S. companies, so you're instantly diversified across the market. But here's where ETFs stand out. They trade on stock exchanges, just like regular shares. That means you can buy or sell them anytime during market hours, and the price changes throughout the day based on supply and demand. Compare that to index funds, which only get priced once a day at their net asset value, and you can see how ETFs give investors more flexibility and control over when they enter or exit a position. ETFs are also relatively new compared to index funds. The very first one in the US, the SPDR, with ticker symbol SPY, was launched in 1993, and it's still one of the largest in the world. Since then, ETFs have exploded in popularity, not just in the US, but globally, because they combine diversification with the convenience of some flexibility. And here's another twist. While most ETFs are passively managed, meaning they simply track an index like the S&P or the Nasdaq, there are also actively managed ETFs. These are funds where professional managers try to beat the market by handpicking investments. Some investors like to invest in them because they allow you to bet on specific ideas or sectors. To make this real, let's pull up a fact sheet for a popular ETF, the VOO, the Vanguard S&P 500 ETF. It should clearly say it tracks the S&P 500, so that is passively managed. Another detail is the number of holdings and the method. You might see terms like full replication, which means the ETF owns almost all the stocks in the index. That's a sign you're truly getting the whole market basket. Next is the expense ratio. As we can see, it's only about 0.03%. That's one of the cheapest funds you'll ever find. Another thing to check is dividends. VOO, for example, distributes dividends, which means it pays out cash to investors, usually every quarter. Some ETFs work a bit differently. These are called accumulating ETFs. Instead of paying you dividends, they automatically reinvest them back into the fund. If you are interested in learning more about accumulating ETFs, then I strongly recommend watching this video. I will leave the link on the description. Then we've got the top holdings and their weights. Here you'll usually see familiar names: Apple, Microsoft, or Amazon. Remember, these change a bit as the market moves since the holdings are ranked by market capitalization, meaning the biggest companies in the market naturally take up the largest share of the fund. Now, before we wrap up, let's clear up some common misconceptions about index funds and ETFs. First, just because something is an ETF doesn't automatically make it better than an index fund. Yes, ETFs trade like stocks, but that flexibility isn't always useful, especially if you're a long-term investor. Second, actively managed ETFs don't guarantee higher returns. Picking a manager who consistently beats the market is really hard. According to Morningstar, only about 3 out of 10 active funds actually beat the market over the long run. And finally, a lot of people think ETFs are risk-free just because they're diversified. But here's the truth. An ETF is only as safe as what's inside it. If it's tracking something volatile, like tech or crypto, it can jump up and down just as much as individual stocks. I would say that choosing between index funds or ETFs really depends on the country you live in and your way of investing. However, the key is to stay in the market with low fees and focus on long-term growth.